Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, now for what is often our daily check on all things Elon Musk. First up, yesterday, you might have noticed Elon Musk acknowledged the impact, financial and other, of his job as head of President Trump's effort to cut the size of government. We're talking about head of Doge.
It's costing me a lot to be in this job. What they're trying to do is put massive pressure on me and Tesla, I guess, to I don't know, stop doing this. But, my Tesla stock and the stock of everyone who holds Tesla went roughly in half. I mean, it's a big deal.
All right, that, of course, was Elon Musk yesterday. And then there's something many of us, you too, perhaps, may have been thinking about throughout the weekend. And since the headline crossed late Friday, I think it was
It was after we were gone, because
Yeah.
I was like, okay, well, this is a Friday afternoon news dump.
I remember coming into the newsroom like, what?
Yeah, I don't know if Kurt Wagner was still at the office at that time.
Yeah.
It's about the time that Elon Musk announced that he'd acquired the social network formerly known as Twitter for the second time in 3 years. Let's get into it with Bloomberg News technology reporter Kurt Wagner. Kurt's the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul. So X-xAI, which spun out of, which was a separate company, startup from Elon Musk, comes out and buys X using stock. Am I getting that right, Kurt?
That's exactly right.
Okay.
Couple important details. Elon Musk, of course, owns both of these companies, right? So this is really, taking one side of his universe and sort of formally merging it with another side of his universe. But yes, this, deal was all stock, valued X at $33 billion, less debt, and supposedly valued X-xAI at $80 billion. And so there will now be this new sort of joint entity between the two that we can obviously talk about. But I think, on the one hand, what took so long? On the other hand, what is happening here? Is this really necessary? And I'm not sure if it really was, based on how they were already working together.
Right. That was actually my next question. You log into X.com, you can actually see AI, abilities via X.ai within the app. They work closely together. What's the whole purpose of an acquisition such as this?
Yeah. So let's pretend these were two completely, separate entities. They were owned by different people, right? I think it would make a lot of sense for an AI startup like X-xAI to acquire X. They now have access to this, proprietary data set, all of these posts and these user accounts that are tweeting every single day. They can use to train their models. No one else now gets access to that. That's a great advantage, or at least a unique characteristic. On the other hand, X is now distributing the X-xAI chatbot, which is Grok, right? And it's getting it out to millions of people who might otherwise not see it. Those kind of synergies, to use the cliche, make a lot of sense. The problem is those things were already happening, and they were happening because Elon owns both of these companies. And there wasn't really, as far as I can tell, any risk that X-xAI would suddenly start distributing Grok somewhere else, or that X would suddenly take all of its user data and, start licensing it to OpenAI, right? Elon would not do that. So the fact that they sort of had these two businesses that make a lot of sense together, they were already doing all of those things before a deal, which is why I'm not entirely sure why you needed to spend, $33 billion to make this formal.
I'm so glad you said that amount, right? What was it? $33 billion to do this deal,
33,
right?
Yeah.
Boy, that number seems so familiar, Kurt. Can you remind me what he paid for Twitter? It was Twitter at that point. What he paid for it originally?
It was Twitter at that point.
Yeah.
That's right. So the Twitter deal was $44 billion, but that included $12 billion of debt. This is $33 billion with about $12 billion of debt, so 45 total. So he's basically buying Twitter, or now X, again for roughly the same price he paid for it 2.5 years ago. I think a lot of people could make an argument it's probably not valued at the same amount that it probably was 2 years ago when he bought it. But that's the beauty of owning this company and being the majority shareholder. You can kind of assign whatever value you want if you're the one buying it with your other company, which is, I think, what happened here.
So is this going to make X more attractive to advertisers, right? That's been how they make money, right? Or they hope to make money. And a lot of advertisers ran kind of after Elon bought it and things started happening. I mean, does this change the future of X?
It's hard to say that, 72 hours after this was announced. But again,
Yeah.
I'm struggling to see a real dramatic difference to X right here, because again, they were already getting all the benefits of partnering with X-xAI, right? They were using X-xAI, they were incorporating Grok and the chatbot into the product. They were, using that as sort of a carrot to get people to even subscribe and pay a monthly subscription fee. So I suppose you could say, well, now they're going to be even closer to, these AI tools. Maybe they'll have more efficient algorithms. Maybe their ad targeting will be more efficient because they'll be plugging into this AI machine. But again, I don't see what would have stopped X from doing those things to begin with, right? They clearly were working very closely, same owner, same goals as a result. And so I'm not sure the trajectory for X changes all that dramatically, in my opinion, from where they were a week ago.
What does it mean for existing investors in X, people who owned X equity? What do they have now?
Well, I think this is a huge win if you're an X investor, right? Because you go from having, millions or $1 billion of stock in this kind of struggling social networking company, and now have millions or $1 billion of stock in an AI startup that everyone's very excited about, right? So you're kind of swapping in the old thing for the new thing. And if you're an X investor, I think, you've probably been sitting around for the last 2 years going, am I ever going to get my money back? What, am I going to get pennies on the dollar for this investment someday? And now suddenly you've not only been made whole, but your money is kind of riding a much more attractive horse, if that makes sense. And so I think X investors got to be thrilled. X-xAI investors, on the other hand, may be less enthused, right? Suddenly they're spending 33 billion or 45 billion, whatever number you want to say, to acquire a struggling social networking company when you already had the benefit of getting all that data anyway through the partnership that they had. So X investors thrilled.
Yeah.
X-xAI investors, I imagine, are maybe not quite as happy.
Who knows? Now you then roll it into Tesla, right? I don't know. No, I'm just kidding.
Maybe.
Careful.
Be careful. All right, Kurt, thank you so much. Bloomberg News technology reporter Kurt Wagner. He is the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's see what Chris Bugatti has to say about all of this. He's Chief Investment Officer at SWBC. They have over $1 billion in assets under management. Chris joining us here in studio. Welcome.
Thank you. Glad to be here.
You've been seeing us update our numbers.
Yes.
Weren't rude. We were just trying to update stuff. Chris, I feel like that there
You
are...
had the TI-83 out. You were like...
Exactly.
I said, Carol, there's a way to do this on the terminal without actually plugging any
Technology has
numbers.
come
Can I
a
just
long
show
way.
you? Yeah, okay. Go ahead, please.
There are you're so right. There are pullbacks, Chris, that are welcomed, right? That take some of the fluff, the air out of the market. And then there are pullbacks and other signals that indicate a market is in trouble. The trade that you see and the pullback that we've seen so far in 2025, which one is it?
I think it's right in between the two of them, to be honest with you. I think that, it's a correction is always welcome when you kind of can see the floor and understand where there's some support. And we kind of saw that initially when we did see down 10% in the S&P earlier this year. But I think there might be a little bit more pain to be had. And so right now we're in between the two, but I think it will be a little deeper correction.
How much more pain?
I'm targeting somewhere down the 5,200 range on the S&Ps for argument's sake. So I expect us to really approach that 20%.
Another 400 points.
Yeah, we're at 5,600 right now. So that's quite a bit of pain.
It is. Yep.
Why do you see that as a floor? And what do you see prompting it?
Well, what's going on right now with the economy is really struggling. It's really kind of introducing a lot of uncertainty unknowns. And as we know, markets do not like uncertainty. And they've been reacting as such thus far this year. And so I expect that we're not going to have any resolution with certainty on Wednesday with the April 2nd deadline. That's just another check mark in the box, so to speak, to look at what the economy is going to do and what the economy could do with the tariff situation. So I expect there to be more uncertainty, more difficulties, and more pain to be had. And therefore, like the technical reason of 5,200 is kind of like there's a lot of support down in that area from a historical perspective.
Is there enough harm and damage that the president could do with tariffs that the damage is not, even when he's maybe done with what he wants to do here and moves on to his next policy focus, is that the damage could stay with us for a while? It could.
I think a little bit of the corollary to that is the fact that some of the initiatives, especially with regulatory environment and what Trump is trying to accomplish in other ways, sets up for a little bit of an easier recovery. If the banks have an easier regulatory environment to lend money, that makes it easier for some of that rebuilding to happen. Same with financial services companies. The more lax some of those regulations become and the easier it is for them to do business helps that recovery a little bit better than what would otherwise be expected. And I do expect that to come into play quite a bit.
There are some folks out there who are concerned about something more fundamental changing in this economy and changing in the U.S. equity markets as a result of policies from this White House. Are you not one of those people?
Fundamentally changing, no.
Fundamentally changing to the downside, like something breaking.
Yeah, I'm not in that camp. I'm reluctant to say that it's not going to get much worse, and we can't see things, that are really challenging. But I don't think it's going to fundamentally break to the point we can't fix it.
Peter Atwater of William & Mary told us that he sees the U.S. could become uninvestable.
Wow, that's an aggressive stance.
Not a concern for you?
No. I think there's still enough opportunity in the markets, the economy, and what we can accomplish that there's still an investable asset class to be had within the U.S.
What could come out of Washington that would make you change your mind about that?
Great question. The more the uncertainty goes on, it's not necessarily what could come out. It's like, how long can we sustain an uncertain environment? The duration of this uncertainty, it just introduces more and more pain. So to the point when if we do have something become unsustainably towards a recovery, then I worry that it's going to really fall off a cliff, so to speak, and that could be the damage. So the longer this persists with uncertainty, the more concerned I become.
So what do you do in this market environment? I mean, since you think that there is maybe a better buying opportunity down the road for U.S. stocks, and you mentioned your entry points, do you just kind of hold off and wait to let the dust settle?
I think you can always do a rebalancing. So look at portfolios. Okay. What can you rebalance? Are there opportunities to kind of set some things better in terms of your overall construction of your portfolio? Looking at things that could be interesting, could be the core goods services that tend to survive well in a downturn of an economy. There's really some opportunity in that space, I think. And then looking at financial services and energy stocks for two different reasons. I think there's definitely opportunity in some of those areas because of the recovery that I'm hopeful of.
Did you raise cash to buy at a lower valuation?
I did not, no. We've got plenty of cash on hand, so from our perspective.
How do you know when it's time to jump back in?
To put your finger in the air and see which way the wind blows a little bit, but no. I mean, you have a game plan. And my game plan is looking at something that kind of submits an opportunity for a good rebound and a good growth opportunity and able to recover into that. So being thoughtful about how to weather that storm, putting some things in cash, instruments, to U.S. Treasury bonds, short-term treasuries, stay liquid. Stay where you can get the money out, have a decent return in the interim period. We had years of a zero interest rate policy environment, and investors really survived very well with very good short-term interest rates. And now it's a matter of, we're going to be looking at an opportunity to reallocate some of those funds.
You mentioned you've had a lot of cash on hand. How much? And how much does it compare to historically what you guys have had?
Probably about 5 to 10% higher.
Oh, okay. So for a total position of
15 to 20.
15 to 20. Okay. And that's not typical for you guys.
No, that's not.
Europe, overseas, it's something we've talked about with a lot of guests. You got excited all of a sudden. Yes. Have you been committing money there? Do you continue to do so?
Yes. I called at the end of last year. I thought Europe would be in a good place this year. And I think I got a little lucky with that call so far in the first quarter.
Well done.
I mean, Europe significantly outperformed. And we discussed some of the opportunities set out there and what's going on with Germany with regard to what they're doing in terms of reintroducing some opportunity to grow the economy. The interest rate environment is decidedly different than the U.S. We're talking about interest rate cuts still there. I'm skeptical on the U.S. interest rate cut environment, but when you're talking about the EU, there's opportunity in that space, and I think they've weathered the storm. And overall, their ability to kind of get through some of these Trump tariffs, I think they're going to do a little bit better job than some of the other areas of the.
How much
globe.
exposure overseas then? Do you feel comfortable doing?
About 20%.
Really?
Yep.
In a portfolio?
In a portfolio.
Whoa.
Yes.
So wait. Okay. So you're there at 20% now?
They're at 20% now.
But you're not going to add to it?
I can add to that. Yeah, I can see adding to that. And, there's some opportunities in the space I think make sense. And, some of my equity calls in that space include something like Nestle. Nestle is a good opportunity because of how they're a big global brand.
Right.
Less worried about some of the offshoring, onshoring concern with regard to their production within the U.S. because they already do it. Mm-hmm. They produce here for distribution here in the U.S. already. So that's a concern that is kind of already taken care of by the way they run the company.
Very cool stuff. Fun talking with you. Chris, thank you so much.
Great, thank you.
Chris Bugatti, he's Chief Investment Officer at SWBC, over $1 billion in assets under management, joining us here, Tim, in studio.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Here's an interesting tidbit from last week. Lloyd's Banking Group has teamed up with the University of Cambridge to train 300 senior staff in AI as part of the bank's tech shakeup. Banks around the world are racing to use AI tools, with the sector seen as one of the biggest prospects for the tech to speed up processes and save on costs, as well as replace thousands of jobs. We had this article back in January.
Yeah.
Bloomberg Intelligence did this report about the hundreds of thousands of jobs over the next few years that may be at risk in the banking sector globally.
Just going to go away.
Yeah, or change. I don't know. I mean, it's hard to say.
Yeah, because I feel like we've heard from people when they talk AI that it's like you're working with someone, like adjacent.
Exactly.
But I also do think that it's safe to say there's jobs that are going to go away, Tim.
So that's what one bank is doing when it comes to AI. No question, every single company is trying to figure out to make sure how they're prepared and really ready to thrive in this new world. Jacqui Canney thinks a lot about this new world. She's Chief People and AI Enablement Officer for the $162 billion market cap enterprise IT management software company ServiceNow. She joins us from New York. Jacqui, we're Bloomberg. We love numbers. We like the hard data. Talk to us about hiring for AI-specific roles and just in the last few months, how that shifted.
Sure. Well, thank you for having me here and on this topic. I really appreciate the opportunity. At ServiceNow, we're 27,000 people. When I started 4 years ago, we were 16,000 people. So we've grown tremendously. And the way I think about hiring is especially in the last quarter to last 6 months, we've been putting AI relevant skills in all of our job descriptions. So whether you come to the HR team, you're on the product or engineering team, or go to market, we are asking and requiring that there's certain AI relevant skills. And if you don't have them and you're here, what's our path to be able to help you learn them and grow so that we can have this fully functional AI workforce?
Okay, so two different things I want to talk about here. One is the AI relevant skills. What are those specifically? I know it depends on the roles, but in general, how do you characterize those?
Well, for purely technical jobs, that's a lot easier in many ways to identify what's an AI specific. But when you come to like on my team, a product mindset, someone who can think about design thinking, and then how would you use technology to solve a problem, an opportunity, what would drive creativity? Speeding up a bad process is not a good idea, but speeding up the right process or creating a new process, having those capabilities is really important.
Wait, so, and forgive me, Jacqui, it just sounds to me like someone who knows how to think. So tell me, I guess we constantly have conversations about AI in the labor market and what it really means. Like I go back a couple of years, right? We were telling everybody, go be a coder, you're going to be needed. And now we're finding AI can do some coding. It doesn't mean that coders are going to go away, but they can maybe get a big assist through AI. So when you think about AI specific skills, what is it? Is it knowing how to talk to a chatbot, or like what is it specific? And I'm asking because I'm trying to understand, I think we all are, what it means, especially those of us who've got kids in college or coming out of college. Like what are AI specific skills?
So I think that they are ways of being able to work with technology. When you think about augmenting your work every day, are you able to remember to use AI? That's, I know, not common for everybody still. So we provide tools and we provide opportunity for our people to work with AI, whether it's our assist or in our Copilot with, Microsoft Teams, and making people feel more comfortable with that so that they can save time, be augmented in their job, and then hopefully feel like they're able to contribute more to the work that they're doing because of the time that's created or the ability to summarize things quicker. In many parts of our company, we've seen where people get more comfortable using AI, their job satisfaction goes up because they're able to deliver more value, more time, more speed, more productivity. But more than anything, it's the ability to spend time on the things that they want to do, which is either with our customers or with our people. And I think that's where you see the pivot of it's a level of comfort. And one of the ways we're baselining that is that having AI 101 training for the entire company so that they can understand this is what AI can do. This is what's right to do with AI. We have a governance structure, not just because you can use AI doesn't mean it's the right thing to do in every situation because what we value. And it's an iterative process. It's probably the largest change management human renaissance, if you think of it that way, in what our skills need to be versus just what it was to maybe once be an engineer. Now having engineering skills plus the ability to have these human augmented capabilities is really what we value here.
So it's interesting to hear that because, you're certainly a tech-focused company, and seeing as many people argue, this is one of the biggest revolutions that we've seen within our lifetimes. I mean, you have some folks likening it to, the invention of the steam engine. I think Jamie Dimon did that in the last couple of years. Some people saying it's as big as electricity. This is a really big deal. How internally do you make sure the tools that you use are tools that are actually providing accurate information to your employees?
That's a really good question. And I know lots of people think about it. We invest a lot in data and technology here because that's the core, right? If the data's off, the answers will be wrong.
Right. Garbage in, garbage out.
Exactly. So spending the time investing in the data, we have an AI operating model where I collect the use cases that we are, wanting to do. How do we figure out what the good ideas are, make sure that they're adding value, again, with the investment in data and technology so that you get good work. But then how are you measuring the ROI? Not just doing a use case to make sure that it, kind of fits the bill of I'm trying something new, but are you getting value out of it? Value out of time, value out of answer, value out of quality, value out of creativity. Those are really important, I think, as trying use cases.
So do you feel like kids are coming out of college with the right AI related skills?
I tell everyone I talk to who's early in career that they should take some kind of class in AI. It doesn't mean you have to know how to create AI, but you need to, when you come to a company like ServiceNow, we want you to know how to use AI. We want you to know how to use AI. We want you to be able to sell AI if that's in your job description. We want you to lead as a leader with AI because it's super complicated. It's not the same as it was back like when I graduated from university. And I think that students are picking that up. It's the ability to see how AI can augment their job, can augment what they want and augment what they do and be able to try and be confident in it. That's what I look for out of an early in career hire.
Are you worried that it changes the way kids think or young people think? Carol and I talk about this a lot. And, and we were just talking a couple of weeks ago about making sure that, the brain is doing what it's supposed to be doing when it's synthesizing, analyzing, and communicating information that you learn in school in the form of, a term paper, perhaps. If you can just throw that in, you could throw all your notes into ChatGPT and ask for a term paper. You're not having to do what we had to do. Does that matter?
Right. Oh, it 100% matters. But I think that there's a generation of students that are coming through that are also very keenly aware that that's not the way that they should be doing their work. I have a 21-year-old and a 25-year-old, so I've got a class of two, that I can think of. And they are quick to point out when they feel like someone is overusing ChatGPT or whatever the tool is that they're comfortable with. And they're looking for that. So I feel like there's a generation of people that are coming through the ranks that understand that there's a way to augment, but there's also a pretty obvious detection when it's not been human, sort of audited or enhanced. And I really have a lot of confidence in that. Now, will we in the workplace be able to govern that? We have to, we have to be able to be, like what is the truth? What is not hallucination? And that's where having someone who is almost the AI business partner right? To be able to check that work, especially as it's becoming new in the workplace, I think is important as using it.
How nervous are you that we kind of don't oversee it correctly and that we make mistakes? I mean, right?
Like, we accidentally program it to destroy us?
Well, there is that at the extremes. But I just, I do wonder. Like, I think, Tim and I have been playing around with it and stuff, and there's some pretty cool stuff that you can get out of it, right? And make you extra productive. But it also makes me nervous that, God, does it make us lazy? Does it make us not double check things? That kind of stuff. Anyway,
what I do worry about, and I don't know that, it would be great to get your guys' opinion, is when you get used to talking to AI, whether it's a prompt or you're working with it, and then you turn around and you're talking to your colleague, are you the same person? And how does that affect how you communicate? So that worries me. And I don't think that we have enough time, in the experience of it to say we know how to fix that or handle it. But that's where these human skills are so important, right? Not to lose the humanity in how you manage a team, or you talk to a person, or you work with a customer, or be empathetic to what's happening in the world. I feel like that is so important and core, because it's going to be more difficult to keep that at the center if you do trail off into just thinking how you speak to the bot or the program or whatever you're using.
Carol, are you nice to your LLM? Like, do you say thank you? Do you say please?
Or like, that was really stupid. Do I do that?
Yeah.
I do that with Siri.
Well, that's an entirely different conversation, which maybe Mark Gervin would join us for.
And they yell at you when you do that.
Yeah, they do.
No, I do think it's a learning process. And, if you think about how ubiquitous searching is in general, is this just on another level? I don't know.
No, I don't know either. Hey, Jacqui, thanks for joining us. We're going to leave it there. Jacqui Canney, she is Chief People and AI Enablement Officer for the enterprise IT management software company ServiceNow.
Haven't you ever done that? You're like, Siri.
Don't say it over and over again, because your phone's just going to go off.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, I've got my cappuccino. I'm getting a little bit charged up. Counting down to the close, about 18 minutes to go.
You better drink that thing.
I know. Otherwise, our simulcast will be like, what's with Masser? We are seeing some buying in the last few minutes, so we're really pretty much moving up to our best levels of the session. So what does that mean? S&P 500, a gain of 41 points, up 0.75 percentage point. NASDAQ 100, which has been in the red up until a few moments ago, is now with a gain of about 4 points, but call it still unchanged. But still, definitely off worst levels of the day.
I want to know what Vinny Catalano has to say about that. He's Chief Markets Strategist at Stuyvesant Capital Management. He joins us here in the Bloomberg Interactive Brokers studio. You were last in with us.
Yes.
Really at the start of the year, January 2nd.
January 2nd.
Beginning of the quarter,
Right.
Beginning of the year,
Right.
A different time, a different trade.
Yep.
Now U.S. stocks are about to conclude their worst quarter compared to the rest of the world since the 1980s.
Right.
Even with today's buying, Carol?
I don't know. I still think we're, if you look at the WEI function, I'm pretty sure we're up. Like for something like European stocks. I mean, Euro Stoxx 50 is up about 7%. That is not the case for the S&P, which is down 4%.
Good point.
For example.
Vinny, what's your view?
Okay. Back on January 2nd, okay, first trading day of the year, I had mentioned about a lower low, okay, in the month of January, that if the market made a lower low than December, that the probabilities were that the quarter and the year would be basically minimal gains, if at all, more high probability that you'd have a negative year for that. And so at first it looked like, okay, I was right for 2 days. and then it turned out that later on, that month we had the rally, and then we made really a substantially lower low at that point in time. So that was one element that's there.
Okay.
Okay. That's history. That's the history part of it. The second market signal related item deals with what is mistakenly called the death cross or the golden cross, that kind of thing. But when you add into that
the slope of the moving averages, because that has to do with the 50-day and the 200-day, okay?
Right.
We're talking market signal stuff now. So history and then market signal, okay? If you get that where you have price above or below, in this case below the moving averages cross, dun, 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 death cross, okay? But that produces too many negative signals, or too many false signals, I should say, okay? The third element is the slope of the moving averages. Okay. And when you do that, the probabilities go up substantially that whatever that is, that signal is one that has a high probability of success. And if you're wrong, you're talking about 30 days later, you'll know you get out with a minimum loss, okay? And this applies to up and down. Well, small cap gave it, mid cap gave it to the downside, and right now you have equal weight and large cap right poised there to break to the downside. So the probabilities are that on a market signal basis, okay, you're going to get a negative signal on large cap, in which I guess the Magnificent Seven become the mediocre seven. Is that the new phrase? I don't know. Okay. All right. So you get that in that regard. So that's market signal element. And then the last element deals with history again. What's coming up after April? May to November. And historically, May to November, and especially in the presidential first year of a president's term, tends to not be good. Put all those things together, and then we can do CFA stuff, if you like. Valuation, PE ratios, dominated by technology. Probabilities are that you want to be, capital preservation really should be the
so you're bearish?
Bearish, yes. Not overwhelmingly bearish necessarily, but directionally bearish, yes.
So you're saying that we go even lower for the rest of the year?
Yes. And the part of this that makes me feel even more confident with this is that I have a call every month with a couple of guys that are pretty smart and pretty well off, and they're looking for ideas to go in, when to buy.
Right.
And I'm thinking, no, I don't think you should be thinking that way. And then I'm watching.
So you're telling them they should be holding cash and waiting to buy?
Yeah, you want to move from cash. You want to be in anything, stay away from economically sensitive issues. Okay, that's the better preservation of capital, away from economically sensitive. And if you're in things like consumer staples, if you're in healthcare, if you're in those kind of areas, okay, if you're in utilities, you know where you're at for the year? You're up. You're up for the year because they're the ones that the money is shifting over to, for those investors that have to be in the market.
So it's the technical indicators that are telling you this?
Yes.
Or you also feel like the fundamentals are there as well?
Well, you add the fundamentals to it, yes. So you take history, you take only one technical indicator.
Okay.
And that's moving averages, because all the other stuff I have not found in a 35-year study that I've done
that
on
matters.
It. Right, exactly. You don't have a really good predictive, a forecast with it. So,
how could, though, potentially, we live in a world right now where so much news is coming from Washington, right? And we've kind of gotten what everybody says is the bad news first in terms of tariffs. We're not done yet. This could be a big week for tariffs, Vinny. And then, the expectation that regulations may be easing and that tax policies, certainly for corporations and the like, could be easier. And that sets up for a much more positive environment for the investment world.
Possibly. But I would look toward the elephant in the room, which is the Federal Reserve. And the Federal Reserve, if you do a little bit of history, the Federal Reserve went from, you remember Greenspan put to Bernanke put, the backstopping the market. Well, that's not the case anymore. Now we're looking at a Federal Reserve that looks at the wealth effect and the positive impact that it has on the economy overall. And that's what's been happening since basically 2011, 2012. So can they step in if you have possibly higher inflation, if you have possibly weakened, and Chair Powell talked about it.
Right.
When he had his talk last week. So, yeah.
All right. I feel a little heavy. This was but it was really, really smart in terms of what we're, thinking about in terms of the market. But you did say, I've got to ask you a question that's on some of the notes. Right. It says, what does Sherlock Holmes, Inspector Clouseau, and Albert Einstein have to do with investing?
Okay. It has to do with reasoning. It has to do with how we come to conclusions on things. I always do the 1,000-yard stare whenever I start talking about this stuff. That it has to do with the big, I call it the big three, which is deductive reasoning, which is Sherlock Holmes, inductive reasoning, which shouldn't be really Clouseau, but we'll call it Clouseau for fun, okay?
Okay.
And then abductive reasoning, and that is going to be Albert Einstein. That's theories. So what you have is you have deductive analysis, fact. You have personal experiences, which is the way most people do it, inductive reasoning.
Yeah.
And then you have abductive, which is theory. So those are the three, and that's what they have in common. Now,
30 seconds.
Okay, real quick. What I did was I went to ChatGPT to ask them, how do you two measure, okay? And you, Carol, are 60% inductive. You are 30% abductive, if you can believe it, and 10% deductive. You're 50, 40, and 10. Right.
So what does that mean?
So basically you're more Clouseau.
She's Clouseau.
And
Well, you're
what?
Clouseau too.
I'm Clouseau. Okay.
You're Clouseau
Okay.
too.
This is why.
I would have preferred Einstein, but that's okay.
So would I, right?
All right, Vinny, thank you so much. Look forward to next time. Vinny Catalano, Chief Markets Strategist at Stuyvesant Capital Management.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.